When people talk about AI stocks, they usually mean the same handful of names: NVIDIA, AMD, maybe one of the big cloud providers. That's the crowded end of the trade, the one every analyst on Wall Street has already picked over. Today, we're looking somewhere else. You can have all the GPUs in the world, but if the data can't move between them fast enough, you don't have a data center, you have an expensive space heater. As AI clusters get bigger, the connections between servers are becoming the real bottleneck, and the companies solving that problem are quietly putting up some of the best numbers in the entire AI space. This is about rotating into overlooked infrastructure plays before the rest of the market catches on. We've got three companies today, each doing a different job in the same supply chain. This isn't a hot tip, it's a way of thinking about where the next leg of AI spending is actually flowing. Let's get into it. The AI build-out is broken down into 5 layers, and understanding them helps explain where the money actually moves first. Land and power get funded years before a data center even opens. Compute, the GPUs everyone talks about, gets funded last, right before the facility goes live. Here's the thing. Almost all of the investor attention and almost all of the valuation premium has piled into just that one layer. Compute has been picked over by every analyst on the street for 2 years running. The other 4 layers get a fraction of that coverage, and that's exactly the kind of gap where mispricing tends to hide. Networking is especially interesting right now because it doesn't just scale with the number of chips, it scales with the number of connections between them. As clusters get denser, those connections multiply faster than the chip count itself. That's a tailwind that doesn't depend on which chipmaker wins. For the rest of this video, we're staying inside that one layer. 3 companies, 3 different jobs, all riding the same shift. Here's the physical reason money is moving into this space. Copper wiring works by pushing electrons through metal. The signal degrades over distance, it throws off heat, and past a certain rack density, it simply can't carry enough data fast enough. Fiber sends the signal as light through glass instead, so it barely degrades over distance and generates far less heat. That matters more than people think, because a huge chunk of a data center's operating cost goes toward keeping equipment cool, and heat has become one of the hard physical ceilings on how densely you can pack GPUs into a room. Cutting that heat generation directly extends how much compute you can fit before hitting the ceiling. And this isn't playing out over some slow, decade-long upgrade cycle. It's happening under real pressure, because AI clusters are being built faster than the supply chain can produce optical components. When demand outruns supply like that, pricing power sits with whoever already has the manufacturing capacity built, not with new entrants trying to catch up. That's exactly the setup for the 3 companies we're about to look at. Amphenol has been making connectors for close to a century, across cars, factories, military hardware, telecom, and consumer electronics. AI data centers are just its newest market, not its whole business, and that diversification matters. This isn't a single customer, single theme bet the way some smaller optics names are. That's part of why this quarter's earnings beat carries extra weight. When a company this large and this diversified posts a beat of real size, it usually means demand is broad-based, not one lucky contract. Management also has a long track record of disciplined acquisitions, buying smaller connector businesses and integrating them well rather than riding a single product cycle. The stock trades at a premium to its own history right now, and that premium only makes sense if growth holds up through the back half of the decade, so expectations are already fairly high. Of the 3 names in this video, this is probably the lowest drama way to get exposure to the theme. Not the biggest swing, but arguably the most durable one if the data center build-out keeps going. Most people know Corning from one thing: Gorilla Glass on their phone screen. But that consumer business built the balance sheet for a company that's spent over a century as a materials science shop, and optical fiber has quietly become one of its most important divisions again, decades after Corning helped pioneer the technology in the first place. The reason its new hyperscaler deals matter so much is exclusivity and scale. When a company the size of NVIDIA or Amazon commits to a multi-year manufacturing partnership, they're not just placing an order, they're effectively pre-funding capacity expansion. That's why management felt comfortable putting multi-year revenue targets out in public. There's a comparison worth sitting with here. During the last big memory chip upcycle, Wall Street kept lowballing demand estimates quarter after quarter, and the stock kept re-rating higher every time consensus finally caught up. The argument is that optical fiber demand is following the same script, just a few innings behind. To be fair, this stock has already had an enormous run, and a sharp single-day drop tells you the market is nervous about how much good news is already priced in. Real momentum against a stock that's already moved a lot. That's the tension to watch. Ciena has been public through a few boom and bust telecom equipment cycles going back decades, so it's worth remembering this isn't a brand new AI startup. It's a legacy networking company that's found itself squarely in the middle of a new upgrade cycle. Its core technology is coherent optics, the smart electronics at each end of a fiber line that decide how to pack the maximum amount of data onto that light signal. The bigger story is a customer mix shift. This used to be a business that sold mostly to telecom carriers, a slow, lumpy, low-growth customer base. Hyperscalers building AI clusters spend faster and spend more, and that shift is a big part of why growth and margins have both been improving. As for the pullback, the read from the analyst is that it's index rebalancing and seasonal mechanics, not a change in fundamentals. That's plausible given the size and timing of the move, but nobody can rule out that some of it is simply the market getting nervous after a run this big. Of the three companies here, this one has the most growth priced in, and the most room to disappoint if hyperscaler spending ever slows. Higher potential reward, but also the one that will move hardest in both directions. Looking across all three companies at once, notice how the valuation multiples climb as you move from Amphenol to Corning to Ciena. That's not random. It roughly tracks how much of each company's business is tied specifically to this AI networking theme versus spread across other markets. Think of it as a spectrum rather than three separate picks. Amphenol is diversified and lower multiple. Corning sits in the middle with real named catalysts, but a stock that's already run hard. Ciena is the purest, highest multiple, highest volatility way to play it. None of those is automatically the right answer. It depends on how much risk you're comfortable carrying for a shot at more upside. If you were only going to start with one position, that diversification versus concentration trade-off is really the whole decision in miniature. And remember, this is a snapshot from one trading day. Prices move constantly, so treat this as a starting point for your own research, not a final answer. Here's the mental model worth remembering from this whole video. Wall Street analysts don't update their models in real time. When a company signs a huge new contract, it can take a full quarter or two before that shows up properly in published earnings estimates. In that gap, the stock is often mispriced relative to where the business is actually headed. Most investors watch price charts, but price often lags the fundamental story, because analyst models lag it too. Tracking estimate revisions, how much analysts are raising or lowering their numbers over time, means watching the fundamentals update in real time instead of waiting for the chart to catch up. This is a useful lens, not a crystal ball. Estimate revisions can be wrong, contracts can fall through, and a rising estimate doesn't guarantee a rising stock in the short term. Markets can stay irrational for a while, even when the underlying numbers are improving. And that ties directly into what we just saw. A big single-day drop doesn't necessarily mean a multi-year growth story broke, but it's also not something to wave away without doing your own homework. Let's end with the risk side, because everything up to this point has been pretty bullish. The most important risk to keep in mind is correlation. All three of these stocks sold off together on the same day, which tells you they're not three independent bets. They're really one bet on AI infrastructure spending, expressed through three different tickers. If you own all three thinking you're diversified, you're not. You're concentrated in one theme with extra steps. Then there's valuation. When a stock trades at a big multiple, it's not pricing in average results. It's pricing in things going right for years. That means the downside if growth merely slows, not even reverses, just slows, can be sharper than people expect. And underneath all of it sits one big assumption, that hyperscalers keep spending aggressively on AI data centers. If that CapEx cycle cools for any reason, all three of these names get hit at the same time. This was analysis and a framework for thinking, not a buy signal. Do your own research, and as always, this isn't financial advice. Thanks for watching. See you in the next one. Remember, at Slacker Trades, we work hard so you don't have to. Come join us today at slackertrades.com, where you can subscribe to both the free and paid trades we take.